Hello and welcome to this MithrilMoney Securities Investment 101 course and the third and final part of our types of shares lecture. We just need a couple of things that we just need to finish off with before we get to the main part today, which is on preference shares and preference share types. So first thing, just to make sure we've covered it, company will exist and we'll talk about the good times again. So the company this year has made some good profits. And good profits have come into the company. The board will then debate whether to pay a dividend, and they propose a dividend. So they organise the AGM somewhere nice, and somewhere nice might be Paris. There's the Eiffel Tower, Paris. What a brilliant piece of artwork that is. And we all go along as ordinary shareholders. We go along to the AGM and we all decide to vote on the proposal by the directors to have the dividend, and we say yes. Now, we can occasionally have one ordinary shareholder, and usually have to physically go along, or at least post something in, who's sitting on the island of St Kitts and Nevis, somewhere in between. Maybe they're there, who knows, on a beachfront property, and they're drinking, they're drinking a bit of a pina colada. So they're quite happy to stay in St Kitts and Nevis. What they can do, if they want to, send a personal representative along, is they can nominate a proxy, Mr. Frankenstein, perhaps. And Mr. Frankenstein can go along and vote on their behalf as their proxy. So we can get these things called proxies. It's people nominated by shareholders to go along and vote on their behalf. Now, another little point we just need to get covered before we get to the types of preference shares. Occasionally when a company starts, and it can be any time, but usually when it starts, there'll be an angel investor over here. And the company go to the angel investor and they say, would you like one of our shares? And the angel investor says, yeah, okay, but the thing is, I can't quite afford the full amount. So I know it's got a face value of $1, this ordinary share, but I'm only going to partly pay that. So I'm only going to pay 25 cents. Now, in reality, this will be 25 million or 2.5 million or 250,000. But I'm not going to pay, at the moment, the other 75%, the other 75 cents. So, I'll send you some cash, 25 cents, and I'll send you an IOU for 75 cents. Okay, and the company says, fine. We'll put both things in the till, 25 cents and the IOU for 75 cents. And they'll make an entry onto their share capital accounts of $1. So the share capital will show $1. They'll say partly paid, but effectively, if you looked in the company's till, if the company had a till, I'll try and draw a till. There we are. There's a old-fashioned 1970s till, where people used to be able to work stuff out without calculators. A long, long time ago now. And what we have there is we've got this till, and if you look inside the till, you'll find the 25 cents in loose change, and you'll find the IOU for 75 cents. Okay, now, unfortunately, terrible things happen, and the company goes bust. The court comes along and will nominate a liquidator. There's lots of companies who do liquidation, often large accountancy companies or management consultancy companies. So the liquidator, I don't know why, I always want to draw liquidators in top hats. I think it's because undertakers wear top hats, don't they, with kind of black silk tied to them. The liquidator comes along and looks in the till and sees, first of all looks at the accounts, and in the account sees $1 and says, okay, there's $1 of capital there, $1 share capital. Then looks in the till and finds the cash and the IOU and goes, okay, first of all whips the 25 cents away, and then see whose name's written on the back of the IOU, and then they go after that person, say, give me those 75 cents or 775 million or 750,000. Now that's the extent of the liability. Most companies have limited liability in most countries, but you cannot forget about that 75 cents. Anyway, that would be partly paid shares and fully paid up. Now, when do you have to pay the green stuff? Again, that would be country specific, company specific, and so on. But at some point, it is paid up. But if it's missing, you as the angel investor are still liable to that amount of money. Now, just a quick note, of course, that they're usually registered shares. So there's usually a register for most shares with everyone's name and address in. But occasionally do check on your due diligence here. In some countries, there might not be a register of share owners. It might literally be if you're holding the share, if you're bearing the share, then the share is yours. Okay, now let's get back to preference shares, the main point of this this lecture. And we've got 4 kinds of preference shares that I'd like to cover today. We'll talk about cumulative preference shares. We'll talk about participating, if I can spell it, shares. We'll talk about redeemable shares, and we'll talk about convertible preference shares. Okay, so cumulative. Now, your basic preference share doesn't have any of these features, but that's like saying a basic car. If you go to buy a basic car, you get nothing in it. You don't even get a radio. You know, you have to buy the radio as an extra paid option. However, virtually all preference shares, but do check this if you're spending plenty of money or any money on preference shares, generally come with the cumulative feature added, but not necessarily. So again, think of car radios. When you buy a car, you normally expect to get a radio, but it's not guaranteed. The other 3 things are, you know, extra. So this is like a sunroof. This is like a massaging seat for the driver. And this is like a convertible car where you can drop the roof. Okay, so the 3 bottom features there usually are extra. The cumulative feature, although not always in the car, is usually their cumulative feature. Okay, let's try to explain these 4 features. So let's start then with cumulative. So cumulative preference shares. Okay, we'll have 2 characters here. We'll have Mrs. P. So there's Mrs. P there, and we'll have Mr. S. So we've got Mr. Also, not Miss, Mr. O for ordinary. So Mr. O is Mr. O. Okay, so we start off. Let's have a look at her share. Her share, which is a preference share, face value of $1, and it has a 10% fixed dividend. Mr. O has an ordinary share, $1 face value, no fixed dividend, of course. He's just going to get what he gets. Okay, let's go back in time. 2011. And the board get together in Paris, decide to give her 10 cents. They can afford it this year. Okay, no problem there. And they give him some money as well. So now is everybody happy here? Yeah. Mrs. P's happy, you know. She bought preference share. Who knows what she paid for the preference share, because it was face value of $1. At 10%, she should get 10 cents. So she's happy. She could have paid $500 for this preference share. She could have paid 5 cents for this share. She could have been given this preference share by somebody as a gift. Anyway, face value says $1. The fixed dividend says 10% of $1. 10 cents is fine. So she's happy. Let's just give her a little tick there. Is Mr. O happy? Yeah, he's happy. He didn't expect to get dividends for 5 years on this investment, so you know, to get 5 cents now is great. Okay, let's rock forward. 2012. Bad year. Bad year. The board have no money. You can't give any money away because they don't have any money, and they're not allowed to, usually to borrow money to pay out dividends. So they award Mrs. P 0. Now, again, notice the difference between her and a bondholder. A bondholder at this point would sue the company. You know, the lowest kind of, you know, subordinated loan stock person would sue the company, and the company would be liquidated to get them their coupon. But she is an equity person, so therefore she has no complaint. She's not happy. In fact, let's take her smiley face off. She's not happy, but nothing she can do. Now, there's only one thing she knows about. The thing she knows about is that Mr. O is definitely going to get nothing as well. Because if she gets nothing, or doesn't get her full 10 cents, then he gets nothing. She is preferred to him. She's a first-class passenger on the plane, and if there are no seats left, she knows the economy seat passenger is definitely not going to get on the plane. Okay, next year comes round. 2013. Unlucky for some. This year, this time, Mrs. P gets her 10 cents. And here's the thing. Mrs. P didn't look at notice the small kind of notes on the preference share and didn't realise that it didn't come with a radio. It wasn't a cumulative one. So Mr. O can get some dividends. Let's change it to show that dividends are variable. She is now livid. Livid. Because she's thinking, what about my missing money? Yes, she got her 10 cents this year, but what about the previous year? Where's the missing 10 cents? Now, she looks in a small print. It's not a cumulative preference share. That's tough for her. She only has to be satisfied each year. So she's extremely unhappy, as you can see. She decides to go back in time to 2010. She buys the preference share again, but this time she inserts a clause on the contract that it's cumulative. And now this cannot happen. Mr. O cannot receive a dividend. She has to both get her money from this year, her 10% of $1. She also has to get the missing 10 cents from the previous year before he can get anything. So if it stays at 10 cents this year, then he gets zip. If, though, the board can raise that amount to 10 cents from this year and the missing 10 cents from the previous year, I can't grab it, so I'll just add it in here. 10 cents, 20 cents. Now she's happy. If I can get rid of these features. Oh, lost her face. What happened to her face? Now she's happy. Okay, and we can also now give Mr. O, you know, something. Not much, because we've spent all the money on her, but because she's preferred. Remember, she's the first class passenger. He's just economy. He's cattle class. So everybody's happy. Anyway, that's cumulative preference shares. Again, don't worry about inflationary effects, purchasing value of money effects. It's just the missing 10 cents from the previous year. All previous years before then have to be recompensed to the preference shareholder, including this year's adjustment of 10 cents. This bit here. Oh, sorry, this bit here. Before Mr. O can get a red cent. Better make that red, hadn't I? So, before he can get anything, she has to be fully recompensed for the past. So that's cumulative shares. So what we need to now move on to is redeemable shares. So let's have a crack at those. So redeemable preference shares. Company again. Sell a share. Preference share. preference share, $1, 10% to an angel investor. And the angel investor says, okay, I'll give you some money on this preference share, so I'll invest some money in the company. But here's the basis. Basically, at some point in the future, let's say this is now 2013, at some point in the future, from 2015 onwards to infinity, though it could be a window, let's say 2018, at my discretion, I will hand back the preference share and you will hand me some cash. And the cash will be specified in the contract. Could be $5, could be $50, could be $2, could be $1.10, could be 80 cents. All depends on the contract. But anyway, he redeems, or she redeems a voucher, a preference share voucher, and receives cash. That's a redeemable preference share, particularly of interest to small companies starting up who make big promises for the future in order to get some money now, with a high chance of being liquidated before they ever get to that point. So that's those there. Now, participating preference shares. So participating preference shares. Again, not a standard feature. It'd be something extra. But let's draw the situation again. So here's Mrs. P, and here's Mr. S. Oh, sorry, Mr. O for ordinary. And it's 2013. And that's again what she got. She's got 10%, $1 preference. And what's he got? He's got ordinary $1. That's it. Okay, 2013. She gets her 10 cents. She's feeling happy? Yeah, should be. She's contractually been obligated there. He gets, I don't know, 8 cents. Is he happy? Yeah, he's happy to get something, because he knows he's bottom of the payment pile. Okay, 2014 arrives. She gets 10 cents. How's she feeling? She's feeling pretty happy. And then Mr. O gets 80 cents. It's been a fantastic year for the company. He's kind of overjoyed, he's not just happy, he's kind of wild and ecstatic. Very, 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 very happy. Now, let's go back to Mrs. P. She was happy. She was happy. And then she sees what he gets. 8 times more than her. She's a first-class passenger on the plane. And the economy season, she got stuck hanging on the outside of the plane, and he got her seat, and he got a massage, and he got a fantastic 7-star hotel at the other end. Not that happy anymore. So she decides to stop being happy. Not happy now at all. Okay, in fact, very sad and very cross even. So not happy. So what does she do? Well, she goes back in time 2 years in a time machine, and she decides to buy a participating preference share. Okay, because she knows what's going to happen. She knows that he's going to get 80 cents here. She gets a 10 cents the first year, he gets 8. She knew that. Okay, so she's okay with that. And then the next year, she's arranged for her participating preference share to participate in some part of the profits. Now, the formula she's chosen, and this formula will be different for every single participating preference share that's ever been written, is she gets a maximum of the 10%, or what the ordinary person, actually let's just make that 10 cents. She gets 10 cents, or she gets half of the ordinary person's dividend. Okay, so the first year she gets 10 cents, 10, or she gets half of the 8 cents there, so that's going to be 8 divided by 2 equals 4. What's the max of 10 and 4? The max of that is 10. So that's what she gets. What about the following year? Okay, so we'll do the max of 10 or 80 divided by 2, which is 40. She should get 40. Okay, so she has to get 40 cents. And then Mr. O there can get his 80 cents. Now, do remember this formula, I've just made this up. This can be any formula. In fact, it's usually extremely complicated, dependent on all sorts of crazy ratios, debt finance ratios, some of this, some of that, delta, sigma, whatever else, calculus, mathematics, Greek characters, you name it. I've made it very, very simple. She gets 40 cents if he gets 80. So she is now, let's take off this unhappy face. She's now very, oh, that's slightly evil, isn't it? Oh yeah, she's slightly evil because she only paid, she only paid 38 cents for this preference share in the first place. She got 10 cents the first year and 40 cents the next year. She's already up 12 cents, and she's still got the asset. So there we go. Now, if we were to do a little graph of that function there, I'll need to get rid of this stuff at the bottom here. Hopefully that's making sense to you. We'll just keep the function. To make a little graph of this, we'll do Mrs. P in red and Mr. O in green. So we'll kind of go with 10 there, 20 there. So as we're coming along in time, she always gets 10, always gets 10, always gets 10. His is variable. It started at 8, go up and down, and it'll start creeping up. And if it gets to 20 and above, then as soon as it gets to 20, her return will always be half of what he gets. So it'll be a curve, something like that. So she has this kind of flat line which goes up at half the rate his does as soon as his gets above 20. And if he gets 19, then half of 19 would be 9.5. Let's just draw that down. If he got 19, half of 19 would be 9.5. What's the maximum of 10 or 9.5? It's 10, isn't it? As soon as we go above 20, then, if he gets to 21, 21 divided by 2 is 10.5. So she now gets 10.5. And that's the way it works with participating preference shares. You participate in bumper profits, and it's an extra feature. It would be a sunroof, it would be a massaging chair for the driver. Let's do our final one then. This is convertibles. Actually, it's probably best if we go back a couple of slides. This was redeemable preference shares. Let's just scrub that out. And now we'll say convertible. And it's a slightly different situation here. Let's get rid of all of this. So the company wants to sell the preference share to our angel investor friend there. And he or she says, yes, fine, that's no problem whatsoever. But what I want to be able to do, let's say it's now 2013, what I want to be able to do from 2018 onwards up to the end of time, that could have a time limit, is at my discretion at any time, I want to be able to hand that back and convert it into a certain number, let's say 5 ordinary shares. At my discretion, if the company still exists and can do all of this, I can hand this preference share back and get 5 ordinary shares. Now, this could be a bumper deal. If these shares are worth on the market $100 each, that's a $500 return. It could be a Google, remember. So it could be a Google. The ordinary shares when we started were 1 cent each, and now they're $500. So he spent, 75 cents on this preference share 1 year, and 5 years later, got $500 back, $500 worth of shares back, converted back. So you can convert your preference share into some ordinary shares. Remember, angel investors, they invest in 100 projects and hope one of them will be fantastic, and know the other 99 are probably going to fail. So this is a great return here for this angel investor. Anyway, that's convertible preference shares. There's the 4 types covered. I think we've done everything we can now on share types. Let's move on to the next lecture. But remember, if you want to contact us here at MithrilMoney to arrange any kind of financial training from London to Singapore and other points west, north, east and south, please do go to our webpage, which you can find via the YouTube show notes. See you next time.